How can you accurately assess farmland market value? Imagine you're thinking about investing in farmland, but how do you know what the land is truly worth? Getting an accurate picture of farmland value is essential for making smart investment choices. It's not just about the price tag you see online or at a sale. You need to understand what factors influence the land's worth and how to evaluate them properly. First, one of the main ways to assess farmland value is through the sales comparison approach. This method looks at recently sold properties similar to the land you're interested in. You compare things like location, size, soil type, and access to water. If a nearby farm with similar features sold for a certain price, that gives you a starting point. Adjustments are made for differences, like better infrastructure or soil quality, to estimate a fair value. Next, the income approach is very useful, especially if the land produces crops or livestock. You calculate how much income the land can generate annually, subtract expenses like labor and equipment costs, and then apply a capitalization rate. This rate reflects the return you expect from the investment. For example, if a farm makes $20,000 a year after expenses and the capitalization rate is 5%, the land's value would be around $400,000. The cost approach is another tool, mainly when the land has significant improvements like irrigation systems, barns, or fencing. You add the value of the land itself to the depreciated value of these improvements. This method helps when infrastructure adds to the land's usefulness and worth. Soil quality plays a big role in valuation. High-quality soils that support high yields tend to increase land value. Soil testing can tell you about nutrient levels, drainage, and fertility. Better soil means more productive land, which can lead to higher income and higher value. Location and access are also key. Land near cities, transportation routes, or markets is more valuable because it's easier to get supplies in and sell crops. If the land is close to roads or has potential for future development, that can push the price higher. Features like irrigation, fencing, utilities, and land topography also matter. Well-drained land with flat terrain is easier to farm and more desirable. Conversely, land prone to flooding or with difficult terrain might be less valuable. Government programs can influence assessed value too. Some farms participate in conservation easements or use value assessment programs for taxes, which might lower the taxable value but not necessarily the market value. Knowing these details helps you get an accurate picture. Finally, broader market trends matter. If commodity prices are high, farmland prices tend to rise. Low interest rates make borrowing cheaper, which can also push prices up. Watching regional and national economic conditions helps you understand where farmland values are headed. To get a precise valuation, many investors hire a licensed appraiser experienced in agricultural land. They conduct a detailed appraisal using all these methods and factors. You can also compare recent sales, review farm income data, and analyze soil test results. Considering restrictions or land use rules is important too, as they can affect how much the land can be used or sold. By combining these approaches, you can develop a clear, accurate estimate of farmland market value. This helps you make smarter investment decisions and ensures your farmland investment aligns with your financial goals.